Hi, good morning to everyone. Well, for me, it's a pleasure to be here today with such an interesting investment panel with so many good investors. I want to make a short introduction. I have Lucille from 8 Roads, Jackie from Katai, Ricardo from Target Global, and Mike from TCB. If you can make like a really short introduction of who you are and which is the fund that you have behind, or the fund that you are partners, please. I don't mind who is going to start. I'm going to ask all the questions like this, and
I can start.
Okay, perfect.
Hi, I'm Lucille. I'm a partner at 8 Roads. We're a global fund, and we invest mostly in scale-ups. Happy investors in a number of Spanish startups like Wallapop, Fever, and Redpoints.
Hello, everyone. My name is Jackie. I'm managing partner at Cathay Innovation. So Cathay Innovation is a global platform investing in Europe, US, China, and Southeast Asia. And in Spain, we're investors in companies such as Glovo or Wallbox, just to mention a few of them.
Hi, I'm Rick, a partner at Target Global. We're a pan-European kind of venture firm investing early stage in growth. Very excited to be here.
I'm Mike Calfine. I'm a partner at TCV in London. We're a global growth equity firm, and we focus on typically later stage technology companies around the world.
Okay, great. Thank you. Well, sorry, I'm Jose Carol. I'm operating director at B Startup. At B Startup, we do financial services for startups and also investment. We have B Startup 10 from seed investment, and then we have Sabadell Venture Capital, where we invest in pre-Series A and Series A. Okay, so I don't know if you have the same feeling, but you have been here for 3 days. We have all, I suppose, been speaking with quite a lot of entrepreneurs, and I don't know if you have the same feeling, but I have a feeling that there is quite a lot of people that it's a bit like, I don't know if the word's worry, but wants to know what is going to happen with the economy. No? We are not now, we don't know exactly what is going to happen, and I want, if you can give your view about what is happening with the economy, how it's this thing that is going to happen, it's affecting to your startups that you have on portfolio, of your investment thesis. If we can chat about this a bit, please.
You want to start?
Yeah, happy to go. I mean, I think you're right, I think, and also we see it also in the boardrooms. It's probably a conversation that is happening everywhere. And we try to have a fairly measured approach. So to some extent, you want to acknowledge and obviously look at external markets. On the other hand, we invest, and I think same for entrepreneurs, like our horizon is typically 10 years. And so obviously what's happening today on the NASDAQ doesn't necessarily have an impact on, what a business is going to become. And so for us, we're trying to, to see what companies could become and what the world could become, not necessarily like what it is today. So trying to keep that balance is important. But talking about the day-to-day impacts for entrepreneurs, obviously, I think a lot of the conversations around extending runways, so making sure that you have a bit more time to deliver, execute before fundraising again. So obviously, some of those conversations are happening.
I mean, just came back from an offsite with the team last week in southern France, and we had a team from the US, team from Asia, and team from Europe. And basically everybody shared their views. I mean, the same way that, Jose, you're asking the question. And reality is that what we're seeing today is like maybe regions are becoming a bit more local, which means that sometimes you expect, international funds to come into your region because as opposed to last year, so they were much more opportunistic. And now it's like they're focusing in their portfolio, they're focusing in their markets. And at the same time, I mean, it's of course about the messages about extending the runway, cutting costs, etc. And what we are seeing in every stage and in every geographies is really process of fundraising are becoming a little bit longer. Okay, and therefore, if you have limited runway, just try to forecast a little bit or try to extend it so that whenever you go to the market and fundraise, you have time, and you have also in a cash position that will not put you at risk. And then on the investment side, what we're looking at for new investment is really also the possibility of with the fundraise to have a clear path toward profitability as opposed maybe to previous years.
I mean, you asked about the economy, right?
Yeah.
So, look, I mean, obviously, at the moment, we have like full employment around the globe. Companies are well capitalized, and kind of at first glance, everything's actually fine, right? Then, of course, and I'm not an economist, but I think all signs indicate that we're going to go probably into a recession, and times will change, right? Or almost kind of normalize if you take the last 2 years as an outlier. So we definitely see kind of multiples coming back to kind of more normalized levels. I do early stage, so kind of we're less worried. I agree with you, right? It's like a 10-year horizon, and kind of valuations are almost decoupled a bit from public markets at that stage because they're more driven by, say, kind of competitive dynamics of the round. So in a way, it's business as usual, but kind of aware that global economy might kind of, or growth will probably change over the next half year, 2 years. Let's see how inflation maps out.
Yeah, I think it's, for us as well, it's business as usual. Many of the greatest technology companies of the last 25 years have been born out of times with economic dislocation. So, it's the kind of the cultures and teams that are forged during slightly adverse times that are often the ones that go on to win. Secondly, the talent markets have been very tight over the last few years, and there is an upside scenario over the next couple of years where things get a little bit easier from the perspective of retaining and acquiring talent for your companies. But look, economic cycles are normal. The benefit that we have and that all of you have is that the secular trends behind your companies are much longer. To Lucille's point, these cycles are typically kind of shorter. They're a normal part of life we have to live with, but technological secular trends are long and present massive opportunities, and nothing changes in that regard.
Okay, so it's interesting. So you are saying that business as usual, but what kind of, you were saying that maybe companies have to try to maximize the runway that they have, but what kind of errors can you think that now entrepreneurs have to avoid because of the moment that we are living, that no one has the crystal ball, so we are not going to, anyone knows what is going to happen, but what kind of errors do you think that people should avoid in a moment like now, which is like uncertain?
Running out of cash to start with.
This is for sure. So, but and if it's running out of cash or maximizing the runway, do you think that maybe this situation could affect on the growth? And if this situation is going to affect on the growth, maybe we're going to find less, I don't really mind about the word unicorns, but less companies that are increasing the value. We don't mind if they are unicorns or whatever, but less companies that are increasing the value because the growth is going to be like not so big or not so fast.
Yeah, no, for me, 2 errors I can think of. So the first one I would say is, I always say, and even before economic questions, like really invest in your finance team, because those are times where you really want to be able to be good at reforecasting, having different scenarios, and suddenly I think like finance team have always been like the the overlooked function, right? Where you invest in product, you invest in go-to-market, and I see counter of companies even at Series B that either don't have a CFO or have an externalized CFO. And I think that would always be my advice, like try to have someone good in place that's going to help you run those scenarios, have a good understanding of your business so you can flex how much I spend. To your point, like, do we invest in growth? Do we invest, in profitability? How much of a runway do we have? What are the levers? And the other thing is there are multiple sources of funding, right? So VC, obviously, all of us, but now I think there's a lot of different colors of funding. So you have venture debt, revenue-based finance, and so those are very good options as well for startups, I think, to extend like another year of runway. And again, like you'll need a good person in the finance team to help you navigate those different options. So to me, that would be one mistake, not to have someone like that. And the other thing I can think of is being too reliant on selling to other startups. And so that's one thing I think in my own portfolio. Are we very exposed? I call like VC tech for VC tech, or like are we only selling into other VC-backed companies? Because if suddenly we're selling to companies and they have less funding, like do you have a compounding effect on you? So I always try to say, like, let's try to diversify your customer base so you're not selling only to tech companies, because if that changes, then maybe we can sell to more like real economy SMB that might be less impacted.
Mm-hmm. Real companies.
Real companies.
I mean, you touched a couple of interesting points. One is the growth. Okay, before, I mean, companies was just pouring an amount of money into growth, and relying on raising another round. Okay, that was the model. To show like 2, 3, 4, 5x. Okay, so to be able to be attractive enough to raise additional money. This is not the case. So what we're looking at, I was mentioning that a bit earlier on, is really having like a model where actually the company, with a couple of rounds, I mean, depending of the stage of the company, you can, I would say, even like control your own destiny. Because, as I said, so the market, there is money. I mean, definitely, it's not that there's no money, but there is a time where there is a correction about valuation, there is a correction about I mean, some business models as well. And if you look at what we've been through with the COVID at the beginning, I mean, the first 2 months, everybody like paused because nobody really knew what will be the impact of the COVID in the economy. What we saw is, of course, digitalization was, actually help the companies, I mean, the economies to survive. Here, as opposed to maybe 2, 3 years ago, I think it's going to last a little bit more, okay? It will not last forever. So, I mean, our guess is, again, maybe something within 18 months. So having that, in mind that within 18 months it's going to be tough, it's going to be much more challenging to raise money, and therefore you can adjust, the spending, you can adjust the hiring, you can adjust the runway, and so forth. And don't be scared by showing a smaller growth than what VCs like. I mean, VCs today are more into, okay, is your company sustainable? Is your model can grow, can expand, and can become a company that will be financed in the shorter time than before.
So, I mean, you asked about questions from kind of mistakes to avoid, right? So I think obviously the last 2 years particularly, there was a lot of money around, and there was almost like a tendency to kind of maximize for valuation, and kind of I think it depends what stage you're at, right? But if you're kind of raising, I'd say kind of instead of, again, maximizing for valuation, maybe look more for kind of who's the right partner for you at that stage, even if it comes at a kind of at a lower valuation expectation that you might have had. And just, I mean, I think in the past we were kind of giving the advice to at least have always kind of 12 to 16 months. Now probably it's more prudent to plan for 24 months of runway. But kind of, yeah, don't get carried away with kind of unicorn or whatever kind of titles and maximizing valuation, but more just make sure you have the right partner who's kind of can add value, and that can also, by the way, fund you through different cycles, right? And not just for that round. So,
yeah, I think a couple of things I'd add is always better to make hard decisions sooner rather than later. A lot of those decisions we don't like to make, but it's the hallmark of a great founder that can kind of be decisive about what needs to be done and really lead about making those hard decisions. And a lot of that is going to be kind of reframing the objectives over the next couple of years to focus on some combination of growth and efficiency. So whereas the last couple of years it's been far more indexed towards growth or growth at all costs, people would say. Now it is much more important to reach some combination. People are much more interested in pathway to break even or cash runway or gross margin profile or the economics on sales. These are the sorts of things that VCs will be looking for, and ultimately I think it's the the companies that focus on that combination and hunker down are going to be the ones that survive. And I think in this environment, survival is one of the things that actually ultimately enables you to win in multiple years' time.
Okay, great. And what about sectors? What do you think that could be the hot sectors for investing in the next, I don't know, 12 to 24 months? Which are the hot sectors that you are putting now more focus on it?
Can we change? We
switch. Okay, Mike, if you want to start, then we change.
Sure. You gonna go? Am I go?
Yeah.
Please.
Okay. Look, there is a lot going on in the technology world, and that's what makes it really exciting. You know, for us, we're seeing a lot of innovation emerge in, you know, look, the sorts of areas that you'd expect, right? AI, climate. We're seeing the technology that's penetrating SMEs or micro businesses increase all the time. We're seeing the financial services markets get uprooted and digitized. So there is there really is kind of, you know, we spend a lot of time here talking about the negative sides of what's going on in the macro, but the reality is that we're at kind of a convergence point, whereas there's a bunch of technological trends which are changing the world, and there's been you know, no better time really to be an entrepreneur and be a VC. So that's a kind of a long-winded way of saying that there is a lot of sectors that I think would be interesting.
Which is interesting, right? Because 10 years ago, if we would have had that conversation, and then everyone would have had, like, you know, great assumptions about the future, AI and, you know, environment, and actually the biggest companies were kind of produced in payments, the most boring sector in a way, right? So yeah, kind of looking to the future is always difficult. But I mean, I think 100% of GDP is in the process of being digitized. So in theory, the whole economy is kind of interesting as a whole. Kind of, if we look at different sectors, you can build big businesses and kind of across all verticals, right? So and then of course health, I mean, I would add maybe kind of is difficult, but in a way needs innovation, particularly now after kind of 2 years of pandemic. And kind of environment is the other, that you mentioned ESG, right? But yeah, those are the two that I think we're still yet to see, at least in Europe, like really big companies emerge.
So when we started 7 years ago, we said, okay, we wanted to do investment in tech, digital. Okay, we were like a little bit more sector agnostics, and slowly also because our model, we onboard and we have as investors some large corporates in different areas. So we've been, you know, working very closely, and actually in the past couple of years, so we have at least clear what works on our side and what are the areas where we are most active at. And for me, it's digital health, fintech, we touched that, sustainability, smart energy, renewables as another one, and then retail consumer. Okay, and one of the reasons, besides of course the technology is you know, embracing all these sectors and also helping these sectors, is also the corporates, because at the end for the startup, I mean, you have the B2C model, but you have also the B2B. And the B2B, what we're seeing, especially during the pandemic, is like these large groups being much more interested in collaborating, in working with startups. And it's not like, okay, let's do a pilot because my innovation team is telling me, you know, let's test new things, but really it's changing the way these groups are doing their businesses. And therefore, this is where we are focusing. I would say, and maybe the last one is Web 3.3. I mean, this is one which is, you know, kind of very 2021, even a little bit before. So you have the emergence of some kind of technology around, I mean, blockchain and so forth. And actually this week, a couple of days ago, we announced a fund dedicated to Web3. And this is where, I would say, 5 categories or 5 verticals where we have been investing massively, and we'll be investing in the next coming years.
I was waiting for someone to mention Web3. I mean, lots of areas we're excited about. Maybe 2 to pick some of ones that get me excited. We've seen a lot in the HR space. I think Mike mentioned it's been big war for talent. But more generally, I think the relationship employee-employer has changed a lot. And so we've seen a lot, we're already investors in spend management, HRIS companies, but we're seeing a lot around retention, you know, how to assess employees, how to have, you know, better benefits. And so that's a space I still continue to think is very interesting. And maybe another one is we're big investors in travel tech. And Spain has been a great country, obviously. Travel is finally back. I think they had obviously a very tricky couple of years, but that's another area that's very large. And I think when you see the experience in a, you know, in a hotel, on a flight, you think like there's there is way more space to digitalize and improve those experiences. So another area which I personally like.
Shout out to Travel Perk. Sorry, shameless plug. On that note.
Yeah, we're also, it's an area that we really like. We have some good investments there, like Exotic and so on. Before we finish, because we only have 2 minutes remaining, time has really fly. I would like if you can finish with trying to give one piece of advice to entrepreneurs. I don't mind on whatever do you really want, but if you just can give one piece of advice to an entrepreneur in these moments, what it would be.
Yeah, I'm happy to start. It's a bit fluffy, but I wanted to use that one. You know, a lot of people say it's a marathon, not a sprint, and I like this expression because I find, like, especially last year, and you know, we're talking about unicorns, and sometimes it gives the impression that it's easy, and it's not easy. Like, we all know it, and I found like this. You know, you read the news, like this person raised 150 million, this person is worth 2 billion, and I think a lot of entrepreneurs, they think, wow, like, what are they doing that I'm not doing? Like, the reality is, like, it's difficult for everyone, right? It hasn't been quick. A lot of those companies took, you know, 10, 15 years to get there. And of course, you have the occasional hop-in or companies that, you know, raised in 18 months. But the reality is, if you look at great companies, it took a long time, and they were up and downs. I mean, if you look at companies in our portfolio like Wallapop and Fever in Spain, they were really, like, you know, roller coasters, and they've built great companies. So, you know, as a founder, you know, don't doubt in yourself, and optimize for the journey.
Okay. I would say don't panic first, okay? Because I know that there's a kind of a sense of, you know, pessimism lately. Okay, so we talked, I mean, some of the questions were, okay, extend the runway, cut costs, etc. Yes, I mean, you should do it because you should manage your company in a more efficient way than it was done before. This is the first thing. And the second one was, you know, touched a little bit by Ricardo, is the sense of, you know, don't think only about valuation, which means that if you have the opportunity to take some money, whether it's equity, whether it's debt, whether it's, you know, just take it, because, you know, 12, 18-month situation will be better. But in the meantime, you need, I mean, you need to continue your, I mean, to fund and to, I mean, the business of your company. So don't try. I mean, I know that the name of this panel is, you know, Soonicorn. Okay, so it means already we are giving you some kind of indication where you should head up. But it's more, okay, build something which is sustainable in the time, and also if, you know, peaks like this ones where, you know, situation is a bit more tense, I mean, it will go back to a better situation in the coming months.
So on the founder level, I'd say sleep well, eat well, exercise. 8 hours, we talked about this before, 8 hours. Good, respect your bedtime. And then, of course, at the end of the day, I mean, on a company level, hire the best people and build a product people, you know, give a shit about, right? And pay for and really care. So kind of build good products and hire the best people. Easily said. Yeah. More easily said than done.
Easy said, and a lot of good advice there. So hard to add incrementally, but look, I think I'm always a fan of when entrepreneurs are paranoid. I don't want to be negative about it, but I think that, you know, it is, you know, it's a founder's job to be thinking around corners, and you know, ultimately those founders are the ones that adapt, and the ones that adapt are going to be the ones that survive in this environment. So I would adhere to a lot of the comments that people have mentioned here, but then also, you know, be cautious and paranoid.
Okay, so guys, Lucille, Jackie, Ricardo, Mike, it has been a real pleasure to be with you. The time was really fast gone away. So please give a huge round of applause to this incredible panel.
Thank you.
Thanks, guys.